Welcome, ladies and gentlemen. Today we have a special guest on, Anu, who's our property strategist at Fresh Start Advisory. And I've brought him along because today we're going to be talking about, your super balance and why, financial planners and advisors don't like property when it comes to super. Mm-hmm. And we're going to talk about the pros and cons about, why they cringe when they hear the word property and debunk that of understanding, maybe property could be a great investment for a self-managed super fund. Mm-hmm. Okay. So, Anu, welcome to the podcast.
Hello, everyone. Glad to be here. Usually I am a listener of the podcast, so I'm feeling a bit famous right now. I'm going to be listening to myself for an episode, so that'll be interesting. But glad to be here and talk about it. It's a big topic. I really do like talking about purchasing and super with clients. It's a bit foreign for most people since they often talk about property as in buying in their personal name or whatnot. So SMSFs in general is like a whole different ballgame that a lot of people aren't familiar with. So in my perspective, a lot of people miss out, especially when talking about retirement outcomes, they miss out on a lot because of that. So really good thing to inform everyone about.
Yeah. And for people listening that aren't familiar with what you do, Anu creates the strategies for our clients, property strategies in detail, puts in a plan, of course, anywhere from 10 to 15 years. And then, of course, you follow up every single, quarter or so with every single client at Fresh Start and review their position and see how they're tracking. Yep. Focusing on personal investments versus super. Mm-hmm. Okay, so just to give people a bit of context, I guess what you're of course you've got investments in stocks and other things as well, and then of course you've got property. When it comes to investing in super, what are some of the things that you hear from our clients when you kind of bring that up as an investment, and what's their kind of, take on it?
I think from what I see with most clients, a lot of them don't realize that they have enough in super to actually go for property. A lot of them, it's more just unfamiliarity is the sort of main, hurdle for them. So it's just they don't know about super purchases. They don't really know what an SMSF is, what's involved in it. So just from my understanding with all the conversations I've had, it's lack of knowledge that sort of prevents them from actually taking that next step. So usually once you explain, the pros, the cons, the different things you need to do to be able to set up the SMSF and start looking into it, then they're like, oh, I didn't know it was like that. And usually with our clients, they've seen the results in property, they know what it can do. And so it makes sense to just leverage that in super. So it's really good. But usually it's like a knowledge thing. That's what I find more often.
And do you know off the top of your head, like what are some of the balances some of the clients have where they think they need more, but they've got enough?
I think usually like when they're on like the 150, 200K range, I mean, that is kind of the border. That's when they're not sure. I think a lot of clients also think that they maybe need a lot more in super, so that it's a bit more, diversified rather than having a lot in property, which is a fair point in all honesty. But a lot of them don't realize like how much they need to actually get into property. So it's that sort of uncertainty. But usually once you provide the clarity, it's like, oh, okay, may as well go for it. Yeah.
What's your take if they got a super fund that's not performing as well as what their property is doing in their personal name? Are you a type of person to diversify that portfolio? I know you can't give advice on stocks and other things, of course, but just for your own knowledge or your own perspective, what's your take on it's not performing too well? And if it was yourself, what would you kind of look at if you're getting a better result in property? Are you the type of person to go, maybe just stick to what diversifying, or you look at what the best return on investment is?
Yeah, okay. So with property versus shares or diversification in general, obviously when it comes to your super, this is all you have for retirement. This is it. So you don't want to mess with super and spend it on crypto, and like if you're not having some sort of guidance around it, it's a really big risk and you're putting your retirement on the line. So really, really important that you don't just do whatever with super. But my perspective on it is it's kind of the same as even in my personal name. The reason I don't go heavy into shares is I think like shares is more of like a rich people game. Like once you've made enough cash or equity and you can invest a huge amount there, that's when you'll start to see the returns being life-changing, something you can actually live on. Which is why we invest in shares and super, and why the government's incentivized it is because rather than us leaning on our pension, which is very, very low, it's like 1.7-ish K for a couple of fortnight. It's like not much to live on. Through your super over a long enough time horizon, you will just get consistent gains to the point where you do have a massive balance, and now it's actually generating you proper returns. If you had like 50K to work with, we're talking about personal here. If you started investing that in super, it's not going to give you life-changing returns. It just simply can't unless you're throwing into extremely high-risk investments, which I would just not recommend anyway. So the way in which you can really impact or change your life is through property, and which is why I invest in property, and it's that power of leverage. That's really the secret sauce to sort of changing your life, is using other people's money, getting a bigger asset so that one grows, and then that's giving you, that percentage there is giving you much more life-changing amounts. So it's the same thing with super. Instead of investing in shares of it, a lot of young people probably have less than 100K right now. It's not going to do a lot for you. It's not going to grow a lot. It's not going to become $1 million in a short time. Whereas realistically, you could potentially achieve that if you were able to access leverage, which you can do with real estate, and then actually get some proper gains from it. So that's my reason for being so pro property in general with anything. So it's like, if I'm so pro property in my personal name and trying to change my life here, may as well do it in my super. And the benefit of doing it in super is it doesn't impact my life as well negatively, because these properties, especially if it's high equity growth, any asset, you're getting high equity growth, high cash flow. It's usually one or the other. When you're doing that in your super, you're getting that equity growth that can actually give you a better retirement outcome at the end, a bigger balance.
And it does make sense, because you buy a property for 500 grand, let's say, it grows by 10%, that's 50 grand. You buy, let's say you got $100,000, you put that straight into stocks, it grows by 10%, which is a pretty good return on investment.
Yeah.
That's 10 grand, or even hit 20%. That's a phenomenal return on super.
Charts, yeah.
$20,000 still. So it makes sense. And the higher that purchase price goes and the more it grows by, like if it's 800K purchase and it grows by 10%, it's 80 grand. So you're always going to be more in front. And I guess I understand that. And I kind of do agree with you as well, where you start in property and you can end up in stocks and then use that capital to put into a company and then get a return of a dividend and of course still get the growth or the equity. Yeah. Then you live off that as well. And it's more of a safe way to do it as well to some degree as well. I guess you can debate on that too. But of course I understand that logic and that thinking as well, as a lot of people do that as well.
Yeah, I'm absolutely not opposed to ending up in a share portfolio for retirement, especially with property, because it's like such a large asset. It's not very liquid. A lot of your portfolio is just going to be locked in that asset. I absolutely don't mind having that once you've built the equity, having that diversified into shares or whatnot. But by that point, you've got a big enough balance where it's actually doing something for you. So really not opposed to it. So I guess for me, the point of the property is actually just to build that balance up as much as you can for retirement. So you just have a bigger balance to work with, can have an zero retirement, and leave more of a legacy to your family and beyond as well. So yeah.
Talking about balance, it's quite interesting because with balances in super, just going off the data that I've been doing research on, ages 60 to 64, the average super balance at retirement in Australia is $361,000. Now, I guess over time that's going to increase because super, of course, for many years, it's only came out probably last, 30 years plus maybe?
Yeah.
Something like that.
Yeah, I think so,
and so, you've got, of course, a lot of people during that time not contributing, and now rules have gone more tighter and more tighter, and employers have to contribute, and they have to, mandatory. But as well, you've got a lot of self-employed people that actually don't put money in.
That's true, yeah.
Which is, I guess, when I started the business and I spoke to the accountant, they said, nah, don't put money in. You can when you get to a point where it's taxes involved, but at this point in time, don't put money in. So I think the first 2 or 3 years that we were in business, Adrian and I didn't put money in at all. We weren't even really making money, the first couple of years anyway. And then after that, we got new advice and, we started contributing as well. But I think pretty scary because $360,000 in super, and I have spoken to clients and people that have come on board close to that retirement age, and they've got probably less than that, which it is pretty scary.
Yeah.
So I guess for the people listening, if you have a super fund, a self-managed super fund, whatever it may be, and you work for yourself, I highly recommend just looking into that because when it comes to retirement, it is the best tax vehicle as well. So we can touch on the taxes involved or the benefits that you get with property and just in other general circumstances when you sell things or sell assets, which is fantastic. But 300, if you haven't got a stable revenue coming in when you get to retirement, like property stocks or other things outside your self-managed super fund or super
Yeah.
fund, you're not going to be able to survive off $300-something thousand. You're going to have to stay
100%.
working till you're 70, maybe 75, and then you can maybe retire.
Yeah, exactly. And I guess whenever I speak with clients, they're always talking about their end goals, what they want to do. They want to be traveling when they're old. They want to just. There's a lot of expenses that could, and especially as your healthcare.
Sorry to cut you off.
Yeah,
There's
yeah.
people that actually don't think like that too. You got those generation that say, no, I want to travel now.
Yeah, that's true.
And everything gets blown on traveling, and then they try and make it up. But when they try to make it up, it's like, I've got a family, I've got kids, I've got a mortgage, I've got dogs, cats. Next thing you know, you can't even save.
Yeah, you can't build it up.
But sorry to interrupt you, but I thought I'll just jump in there.
No, that's all good. I was just saying that balance that you mentioned, that's like living the bare minimum, just sort of passing through. Even like as you get older and older, eventually there will be health concerns and more expenses. We're not even talking about like aged care or anything. It does become more and more expensive the older you get. So in my perspective, especially when it comes to retirement, I would love to be able to stand on my own two legs and not rely on the pension. We don't know what the government's going to do. They do all sorts of crazy things all the time. So having to rely on them purely for your retirement, where they might not be people around you. You might have kids, yes, but they're going to live their own life at the end of the day. Like, you don't want to be fully relying on them as well and put that burden on them too. So how can you sort yourself out and make sure that you're set for retirement through your own asset base? And even that pension figure I told you, that's not a lot to live on. Even if you got your own home paid off, it's not a lot. That's why they've sort of brought out super. So, hey, you guys can contribute. Your employer can contribute to your retirement, so that you should be sorted with just a super basic investment strategy. So yeah, that's very little to sort of finish on. 300K is not much.
No, it's not. And I think I was looking at as well, like what the medium contribution is as well for people. And I got this from an article. So looking at it, ages 45 to 49 is about $9,500 a year contributions.
Mm-hmm.
And then you got 50 to 54 goes to 10.5, and then 55 to 59 about 12, nearly $13,000 a year. Where I sometimes, and I think this might be good to dissect it for people listening, look at your super, what it's doing. Okay, if you're putting $10,000 a year, but your super's growing by 5% of that $10,000, that's not a lot of money you're generating.
Yeah.
And so what your super's getting invested in is very important too, I think. And I think that's why sometimes these super balances, they're very low from a balance point of view because of that, what it's getting its money invested in as well. There's different types of risks. You got your low risk, high risk assets, of course. But sometimes a majority of people actually don't know what their super is getting invested in. They don't know if it's a bond, an ETF, stocks, all the terms that they use. It's like, oh, okay. Yeah, it's great. I've heard of what a bond is or an ETF is, but they don't know what it actually does and what it is.
Yeah.
And the next thing you know, they've put their money into something like this. There's fees involved, charges involved. They don't know what it is. Everyone knows what property is. And the next thing you know, you've got this balance that hasn't really grown at all. And I've seen it for my own personal balance, to be quite honest. I'm doing a self-managed fund right now.
Yeah. I mean, even with super as well, I mean, I think most people, especially like the younger generation, you'll hear about super, but they don't really look into it too much in general. There is a huge difference. Even let's just say you're with like major super funds. There's a massive difference in like the fees you pay. Even no one really looks at like the fees of each fund, the performance of each fund, and like most people like they stay with the super fund provider that they started with. They won't change it because why? It's probably all the same, right? But there is huge differences. Even when I went to it with my financial advisor, me versus my partner, the amount we're paying in fees, the gains we're getting completely different. And so as you compound, especially talking 20, 30, 40 years, that difference just continues to compound as well. So it's really important, even just within super, that you're trying to maximize it, because at the end of the day, it's something that will make a huge difference at the end. But those changes are very subtle. That's with subtle changes. Now imagine you're investing something that's leveraged and giving you better returns. You're going into property, and that return is even more compounding. It's so hard to describe the impact of even property. We talk about how impactful it is in 10 years. We do 10-year plans, 20-year plans. Imagine 30, 40 years. The difference is very, very significant. We're not talking just tens of thousands, it's hundreds of thousands, potentially millions. So yeah, it's money on the table at the end of the day.
And I guess when you do go to these advisors, people may not know, but for some people they will. They get a kickback, of course, for whatever they're investing you in. So there is a conflict of interest. And nothing wrong with that. That's their job, and I understand. I'm not knocking anyone that's a advisor or planner. But as well, if there's an incentive there, of course, there's a bias. It's like if I was selling an off the plan property because I'm going to get a 40 grand kickback, like some BAs do, of course, I'm not doing it because my client's going to get the best result. I'm doing it because I'm going to get, a kickback as well.
Yeah.
Of course, there might be, that level of, it's going to give them a great result, but is it the best result? And of course, there can be other better ways of doing it as well. And I think property offers that as well to people doing this in a self-managed super fund.
Yeah, for sure. Look, with anyone giving advice, I mean, the investment world is vast. There are so many investment vehicles out there. It's very unlikely for someone to know a bit about every single one. So with most financial advisors, from my experience, they know a lot about shares, bonds. There's a lot of investment vehicles in that world alone. Usually they wouldn't have gone into property a lot themselves to even learn about it. And there's not a lot of information out there for property. Even for people, you've listening to the podcast, you would have probably learned a lot more from podcasts or listening to companies that do get involved in the space. But from my experience, a lot of property knowledge is from experience in the space. You couldn't really go to uni to learn about, you can learn about basics in property, but most uni professors wouldn't have had a massive investment portfolio themselves, right? So property is a bit of a different topic compared to all those other investment vehicles. So it's not like they are, I think, trying to push people away from property, but I think property is something that is still risky. Like we see all the time people buying property in areas that are not good. They're looking for properties that are places where they might live, but it doesn't make sense as an investment. And so if you do pick up the wrong property and you're not actually finding the right areas where it's an investment, then you might be actually slowing yourself down, especially if you're not diversifying. You might have had a better result into going in shares, right? So what would you say to that?
Yeah, I do agree. I'll give you a story. I got a client. His name's actually Francesco as well.
Okay.
He's
Yourself.
Francesco, if he does listen and watch our stuff, he's in his. I'm pretty sure Frank's in his 50s.
Yeah.
And if I got you, if you're younger, Frank, which I know he's around that age, but if he's older, I apologise. But he bought a property off another buyer's agent before he came to us. Okay, and he bought 2 properties with us after this experience he had with another buyer's agent. It was a buyer's agent that sells off the plan properties, pretty big company. I'm not going to mention the name. So he goes out and buys this property in his self-managed super fund. He buys this property for, I think, $500,000, something like that, in Footscray, in Victoria, Footscray, which is in Melbourne, high-rise apartment, okay, right next to the new hospital where it's getting built.
Yeah.
There's hundreds, if not nearly thousands, of properties coming onto the market. Okay, it's a 1-bedroom, 1 bath, 1 car spot, high-rise apartment. Buys this thing in super, takes 2 years to build, comes down to settlement. The property has to get valued. The property, I think he paid $550 or something like that for it, for memory. It got valued $160,000 under the purchase price. I remember Frank came to me and he goes, Frank, this is what's happened, blah, 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 blah. What should I do? I'm like, go back, try and get another valuation. Went back on another valuation. I think it was maybe 80 grand or something like that. Yeah. Went back again. These guys had nothing to do with it. He was calling the people at the company, weren't answering the phone. Eventually, I think he got it for maybe 30 to 15 grand, just below what he paid. Don't quote me on the numbers. I know Frank will probably be listening to this, but it was just the moral of the story was, anyway, it came below the valuation after the third one. He had to put that extra in. So imagine you bought a property, $550, you got to put down the 20% deposit, plus you got all the closing costs, plus you got the fees to set up the self-managed super fund. Has to put in I think it was 15 or 20, it's 15 to 30 grand. I can't remember what it was, but you have to put that extra on top. So that literally doesn't go to the mortgage, it just goes to the bank.
Yeah.
He's got that property today. He was trying to sell it, looking at selling it. There was properties getting sold in the 400,000 that were the exact same as his. And he was calling the agents, doing research, and they were looking at going, Frank, these properties have been on the market for anywhere from 60 to 90 days to try and sell them, and they're going below what he paid for. He's there freaking out, going, what have I done? And, it's a scary thing because getting close to retirement, and Frank's got this property, and I know how much it burns him. But at the same time, it's do you cut your losses? Do you hold on to it?
Yeah.
Hold on to it. If it doesn't grow, you've just lost all those years of growth as well.
Opportunity cost.
So it's opportunity cost as well. And sometimes I think it's just best to cut your loss and go into another investment. But there is risks with everything.
Yeah, exactly.
And you can put your stuff in mutual fund or ETF and get your 5, maybe 7% return, maybe sometimes even 10% some years. No maintenance, no issues like, when it comes with property. Or you can go buy property off the plan and make a mistake like that too, and it's undervalued too. So there is risks, and there's probably more risk, I would say, probably with property.
100%, yep.
So
compared to like an ETF, yeah.
Yeah, you can there's so many options, and the problem is people actually think they know property and they're professionals. I think that's the stigma you get with property, and people go do it themselves. It's like, well, I'll pay a buyer's agent, I'm going to do it myself. I'm going to buy my own backyard. And they go buy something and they maybe can only afford 400, 500, 600K purchase. Like you can't get a house in Melbourne for that. So he's like, let's go buy a townhouse or let's go buy off the plan property.
Yeah.
And next thing you know, you've got this whirlwind of pain because it hasn't done anything.
Yeah. No, that's those sort of stories, I guess, is sort of where my passion for property comes from as well. I've been burnt in the past from, a bad advisor, or buyer's agent. I wouldn't even call them that.
That would be good to share of what happened there with you.
Well, I guess what pushed me for it, or for property in general, is I'm big in investing. I'm big of building equity, building income, doing stuff outside of your job to further yourself. Invested in all sorts of things, pretty much everything under the sun. I've tried, learnt about it. Same thing with property, but with property specifically, I was very much in the understanding of there is a lot of value in having a professional that is in the space to do it for you. You can get it, same with the shares. I went to a financial advisor. They know a lot more about different financial instruments and products. Same thing with property. Went to an advisor. The unfortunate thing is I didn't realize that the property space was such a wild west. I just thought that everyone sort of knew what was the go. Even you speak with real estate agents sometimes, you'll be surprised how many don't know much about like property investing, even though they're in the industry. It's insane. But I went with an advisor. It was an off the plan. Sounded really good. They talk about the tax benefits, everything like that. And after I bought that property and it settled, I was still learning. I didn't just buy it. I just kept learning about property more and more. The more I learned, the more I realized that this property wasn't really aligning with what it should be. Instead of
what
focusing,
were the things that you seen that it didn't align with?
it was more that I was looking for equity growth, right? Equity growth, you typically want to pick up a property where the land value, that's the asset, the land is the asset. When you get an off the plan home, most of what you're paying is for the building, which is the depreciating part. So that's why they talk about tax benefits a lot. It looks good on paper, but you're not looking at the opportunity cost of having a better asset with way more appreciation. So they talk about, yes, you build this property. So the reason why it was so bad is this property will not grow. It's in an area where there's continuous more supply for the next however many years. It will just not stop for ages. There's so much development area around it. Built the properties. So let's just say I spent $1 million, maybe half of that is the building. That's like, so my investment was like really the land is 500K-ish roughly, right? So just everything I've learned about this asset, it's almost the exact opposite of what you want to buy. It's like, oh, it's nice. If you maybe want to live in it, it's okay. But as an investment, it's absolutely terrible. You would rather buy an established property in an area that's maybe ideally landlocked or there's just no developments. That's how you get equity growth. You need that supply and demand to really weigh in on your favor. So as I learned about these things, I realized that even though I literally built, this is like over COVID. So the building costs and everything, or building itself took ages. So the interest costs, I definitely lost money on it. But this asset, maybe it's gone up since I sold it like 10, 20K. I bought a property earlier this year and that's gone up 80K. I've already opportunity cost wise, I've completely floored the previous property.
Different market, but not
different market, completely different market, established home, bit of an ugly duckling, did some really minor work like paint, flooring. That's an asset that I've built equity into it on top of buying an area where there's going to be increased demand. So yeah, it's unfortunately a bit of a wild west. And then I sort of learnt that a lot of these, those type of buyer's agents where they're doing off the plan homes, they get big kickbacks from the builder. So you're kind of losing a lot of equity there as well. I don't know if I can say that, but yeah. So it's like they're not really like telling you to buy these assets.
So there wasn't a fee when you bought this?
No fee, yeah.
No fee?
Yeah.
Yeah.
So they're getting the kickbacks from the builder. So you can see where their interests lie or who's their real clients, the builder. They're almost like marketing.
Was it just the one you got off them?
I got two. And then
So you got two?
I got the second one. So while I was going crazy with property, I was going buy one, then buy the next. I was like really pro property. And then I had to just pull out of the contract for the second. Again, paid money, paid for lawyers, got out of that contract. but I get
Why?
opportunity cost.
Why did you get out of that one? Was that when you noticed, when you said, okay, this is the first one I've got?
So first one settled. I learnt that it was a mistake, and I went for the second like just straight away, just like yep, just let's go again as soon as I could. And then as I was learning, that one wasn't going to come around for a while because that area is still developing. So it's like I put money in for the area for when it hits that stage, but then I'll realize, oh, this is just the same property.
Where were, if you don't mind me asking, where were the locations of those two properties?
The one was in Wallen, one was in Rockbank.
Okay.
So I pulled out of both. And yeah, if you look at those areas now, there's going to be non-stop developments for a really long time.
They haven't done too well.
Yeah.
So you use that and you said, okay, let's go buy a property. I know this has gone a bit off topic, not personal, but it's actually good to hear that, everyone can get it wrong.
100%.
And you can go to these other people. Don't get me wrong, there's people that spruik and do these type of things, but that's in your personal name. That was in super as well. You would have lost a lot of money, and then it's like set you back as well. And it still sets you back now as well. But I think the thing is that you can play a little bit more with property in your personal name than what you can in the super. It's more red tape.
Yeah, that's right. There is a lot of considerations when it comes to super. Like I said, it's more red tape. There's a lot more like auditing processes. There's payments you have to pay to make sure you're really compliant. One of the biggest risks is you don't want to, you don't want to do any dodgy stuff with your super. It is regulated. Like you don't want to, buy a property that you're going to maybe live in, or it's like you can't do like funny things in super. It has to be proper investment and stuff. But it's like the same thing. I guess the point of that whole story is if you're going to try and buy an asset yourself without any sort of guidance, or a lot of clients might want like a property that's very high cash flowing off the bat, but those properties don't give you equity growth. That would be a massive mistake if you bought that in your super as well. It wouldn't really be growing. Yes, you might get some positive cash flow if you bought like an apartment, but the cost of that equity growth is huge. It's a massive amount, especially if it's compounding over time. So
especially if you're young, but as well, I think if you're young and you get something like that, and it's got the cash flow but no growth, you need that growth when you get to retirement.
Exactly. Yeah. Every asset has like a pro and con. You either get, especially if you're just talking about equity growth versus cash flow, if you've got a massive amount of equity growth, you can expect those properties to not cash flow. If you get an asset like a commercial that's high cash flow, expect it to barely grow. It's not going to grow. Obviously, there's some little things you can do to get some growth in it, but in a general sense, it's not going to grow. So
when you say not grow, you still get the growth, but not as strong as what you get with residential. Is that your?
I mean, it's not much more than like even inflation. Like you kind of just, once you pull the trigger on cash flow, yes, you get like, it will grow, but way less than what you'd get in a resi asset in general, or even like shares, for example. But the cash flow is amazing for those assets. So that's why it's what you want to time making that switch or consolidating these assets for when you want that cash flow. So I guess if we're talking SMSF, timing's a bit easier because you can't really touch that cash flow in a way until you're about to retire. So that's probably when you want to build up that equity as much as you possibly can. Maybe you buy some cash flowing assets in between to increase your borrowing capacity, which is a bit of a different topic. But ultimately, you want to build up equity until you're ready to access that money and hit that age. So it's a bit easier to figure
I think we'll talk about, I guess, a plan, but a bit of a plan. I know you've got something for us as well, and we'll discuss that so people can get an understanding of how to structure a self-made portfolio and things like that as well. And I think some of the negative consultation or views, I should say, that you get from, or the feedback that we get from clients when you set up a self-managed super fund is fees and all the things that are involved with it. Do you know, or if you want to shed some light? I know you're not, once again, this is not financial advice. We're not qualified CPAs or financial planners when it comes to fees and things like that. But I guess, what are some of the, I guess, the mindset that you have to tell or teach with clients when it comes to taking that step and looking past fees and what's involved with super?
I think it's very similar to the conversation around trust purchasing. So when you look at trust, let's just say you're buying one property. If you're buying in a trust versus your personal name, if you're just buying one property, trust looks so bad. Like all the fees, the interest rates be increased, everything about it looks worse. Essentially, if you just consolidate all the information or the downsides of a trust, it's just more expensive to hold that asset. It's the exact same thing with super. There's like all these audits you need to do. You need to set up the bare trust. You need to do the ongoing audits, assessments for all the compliance aspects. In essence, it's just going to cost you more to hold that property. But the pros and why I'm so like pro trust or pro super is if you're able to, so in the conversation of trust, if you're able to buy just one more property that you normally wouldn't have been able to if you bought everything in your personal name, that equity growth, we're talking hundreds of thousands of dollars, is going to far outscale the couple of thousand or tens of thousands that you spend in having a trust over 10 years, right? Same thing with super is the growth that you'd see in buying a good, emphasis on good, not like a bad property, the growth you'd see in an asset like that, we're talking many hundreds of thousands of dollars. So the couple of thousands of dollars you're spending extra a year is completely dwarfed. So it's very much putting that investor hat on and not being, not getting worried about those extra expenses, because if you've got the big picture in the back of your mind, it shouldn't phase you.
So what I'm hearing is you buy a property that's in your super fund from the growth, and because it's thousands or tens of thousands, if not sometimes hundreds of thousands of growth, regardless of if it's a $6,000, $7,000 setup fee, or even sometimes $10,000 setup fee for a self-managed super fund, to disregard because of the opportunity is much more greater.
I wouldn't say disregard. It's good to understand it, but just like with property
Put
in
it in
general.
the back of your mind and say, okay, look at the future of what you can actually gain.
Focus on the gain. Focus on, at the end of the day, it's like running a business, right? If I was able to tell you like you'll get $1 million, but to get the $1 million you've got to spend 50 grand. Alternatively, I'll give you maybe 100 grand, but you have to spend like 2 grand. It'd be a bit silly to be like, nah, I don't want to spend the extra thousands to get the gain.
Yeah.
You know what I mean? So it's like you've got to be aware about those expenses and understand them, but you've got to really focus on what you're getting. Like, what is it that you're putting that money into? Same with property in general. Like, let's just say you have a random maintenance or an air conditioner blows out, right? It might cost you a couple of grand. You shouldn't really be phased by that, because you should know, if you have a plan, that this property is expected to grow by hundreds of thousands of dollars. Unfortunate, but it's okay. It's all accounted for. At the end of the day, I will see that return.
Yeah, definitely.
So that's the sort of mindset
Big
you need
picture.
Yeah.
Looking long term. And I think it's people that are listening to this and that's their first time investing, or they haven't invested before in super, or even just in general. I think it's very important to understand the mindset game of this, because people look at things as a cost and an expense, and it stops them from doing something.
Yeah.
And so we get it all the time. It's like, oh, what, I got to set up self-managed super fund. Yeah, this is what you can do. They go and speak to their planner and their accountant to get the, get the advice and the fees involved. And normally how it works, if people are listening to self-managed super fund, you'll speak to an accountant. They do the setup of the self-managed super fund. Everyone charges different fees. It can be $2,500 to $4,000, sometimes $5,000, depending on what's involved. And then they have to go to a financial planner or advisor to get a statement of advice. Okay. Statement of advice, I guess, is a general advice to, what other investments and liabilities and insurances and things that you will need. Okay. Yeah. For some people, you can disregard that. For some people, it's probably very important, and that can fluctuate from $4,000 to $6,000, sometimes more. So, but then you look at the cost, like a $10,000 setup. Then you got to get a bear trust involved. A bear trust you have to set up when you buy a property, put the property under that trust in the super.
Yeah.
So that's another probably $1,500 to $2,000 for a bear trust, depending on who you speak to. It can be cheaper than that as well.
Yeah.
And then, of course, once you buy the property in the self-managed super fund, you've already heard probably $11,000 or $12,000 so far on all these fees. Sometimes it can be a little bit less than that, who you speak, depending who your accountant is and your planner. Then you've got an auditing fee, which is a separate auditor that will check and review your super to make sure it's compliant, doing the right things. You're not you're investing your money the right way and not taking it out and putting your personal name, etc. And then you have to pay as well accounting fees as well, and that can cost anywhere from $2,000 to $4,000 a year per year.
Yep.
The more assets involved, the more that fee can go up.
Yeah.
So people hear that and they go, "Oh my god!" And even I say, "Oh, it is a lot of money."
Yeah, 100%.
Okay, and I agree with that. And I think sometimes having the right team as well and making sure you get that right advice. If you want to get a statement of advice, once again, it's not financial advice, but it's up to you if you want to do that. So some people like myself, I know what I'm doing. I don't want to get that. Just give me my super fund. I don't want to do. I do this every single day.
Yeah.
But there is a lot involved, and I think that mindset is learning about first. What's my return going to be? Can I put a plan in place, look at property, and see what it is? See what I can do. I would recommend doing something in your personal name and see what you can do if you use a professional like a buyer's agent or property consultant, whatever it may be, and see that return. As soon as you start to see a great return in your personal name, and you start to say, "Oh my god, I bought a property, $500,000 today. It's worth $800,000 after 5 years or 3 years, whatever it may be. Oh my god, can I replicate that in super?" And if you can replicate that in super and do the same thing, rinse and repeat, that's going to be a better result 9 times out of 10 than probably other investments.
Yes, I'm yet to find an investment that can do better, to be honest. If there was one, even that 1 out of 10 that you're saying, I would love to invest in that. I haven't seen anything better than property, and why I'm so pro gung-ho, super aggressive in property. I'll literally buy one as soon as I can get my funding or anything. As soon as I'm ready, I'll literally buy one. Because from what I've seen, that leverage that we're seeing, I have not seen an asset unless again, there's going to be assets that perform better. Like technically, if I had a crystal ball 10 years ago, I would have just bought a bunch of Bitcoin, right? But when you're talking about what's reliable and historically has performed and is safe and secure, and that's why the banks allow us to leverage so much because they're very, very confident in property as well. That's like the best, sort of more surefire way that I found to make the most return. So yeah, but I agree with you. If you've done it in your personal, you've seen the gains, you've seen the expenses, and you understand it, then you have really nothing really holding you back from going into your super. Because if you're like a new investor and then you haven't invested in property and then you're buying in super for the first time, then all these extra expenses are going to make property investing in general seem much harder than it is. When you buy in your personal name, all those expenses you just mentioned aren't there at all. And you get the tax return as well of whatever expenses are there. So it does seem a lot more simpler. But I think once you've seen the equity gains, it would be almost silly to say no to hundreds of thousands more because you're spending a couple of 10,000-ish more, right? So
Yeah, I agree.
yeah, so that's the sort of mindset you need to have.
What's the maximum contributions that you can put in super if someone was listening to this? So don't go over, because there is a threshold from my understanding.
Yeah. So the threshold, I believe, this is where you really need to work with your accountant and broker though, especially if you're talking about borrowing for buying a property. So the maximum is 30,000 a year, but you can
Is that income really goes off income, or no? That's depending on your
No, it doesn't go off income. So it's just the same for everyone.
Okay.
Yeah. So 30,000 a year, but sometimes to make a deal work, you may be speaking with a broker and they say, hey, we don't have enough borrowing in your super or your SMSF to buy a property. You can do additional contributions to do so as well. But that's where ideally you want to speak with financial advisors, understand your position to even do that. Because keep in mind, you can't touch your super money until you're retired, right? So if you're doing additional contributions, it's completely separate.
Will that help with your borrowing capacity too?
Yeah. So what they look at is it's almost like how much income goes into the super. So it'll be your contributions, extra contributions. It'll be what comes from the employer. It'll also be when you do have a property, your rent that goes in as well. If you're a commercial property, that'll be very positive. So it's almost like an additional income in its entirety. So as opposed to your personal, they're not really looking at your expenses, your lifestyle, anything like that. They're just looking at what are the contributions that go into super, and then they assess your borrowing based off that.
Yep. Okay.
Yeah. So sometimes you can do little tricky things where you increase your contributions to make the deal work. But keep in mind, once you go above that 30K cap, you're paying with after-tax income.
Yep.
That's like one of the key benefits of adding to super is it's pre-tax. So after-tax income, but that's where it depends on your goals and your strategy and why you want that property so bad.
Yeah, and I guess you got the people that get close to that retirement age, they start to contribute that
Yeah.
a little more to catch up as well, which you probably want to avoid as well at the same time.
Yeah.
So if you do it earlier on, you can, then rest easy at the end sort of thing.
Mm-hmm. Yeah.
Have you got a bit of a plan or a strategy for people that are listening if they want to do something in property, or even a comparison of stocks versus property as well?
Yeah.
So they can just understand.
Yeah. I'll do a bit of a comparison now. I've run some numbers. I've done it for over 10 years, right? So this different will be further compounding the longer the time horizon is. And it gets more and more insane, especially when you go to like 20 years, 30 years, etc. So if you're young and you have the balance, yeah, it can be quite vast. So essentially what I've done is I've worked with the two scenarios, about 200K as the balance in super. So if you're investing in shares, let's just say we got 10% compounding. 10% is good returns. Like I looked at previous like super funds, what their performance is, somewhere usually between 9 and 11%. That's like the top performance. So usually that's what we'd expect. So if we have 10% compounding for a 10-year time frame on 200K, we're looking to walk away with around, and also let's just say we sold it. So tax, we're looking to walk away with around 470K after that tax. If it's in super, it's like 15% tax, right? As opposed to property, so we would be able to buy an asset for around 650K-ish, roughly, around that sort of ballpark. The beauty about property investing in super is the capital gains is 10%, which is amazing. So it's a very viable strategy to buy, hold, let the asset grow, maybe let it double and then sell it down. I'll talk about that strategy further. But let's just say we're going on a 10-year time frame. When we're taking into account rent, so I'm using like very average and conservative numbers. So the rent only going up 2% per annum, the rental yields being 4%. Like these are numbers that we beat every day in general, but just being as conservative as possible. Average rent, we're talking about maybe we're getting like 30K-ish per annum. The interest rate's about 36K. So this is a very negatively geared property. Overall, with all the costs, we're spending about 17.5K, 17K. This is more negative than what I'd usually see with the property, right?
Yeah.
So this is a more negative property than normal. The net property value of this property, and I'm assuming around 6%, 6.8% growth year on year. So just an average Australian growth rate. Keep in mind, if you're buying a property in a good area, this is even going to further compound. I'm just really trying to highlight, I'm being as conservative as possible, not trying to bias this in any way. The result of our net property value after 10 years is $1.476 million. So if we've got a 600K loan, for example, like let's say we bought like 650 property, I think in this example I ran with like 700, so put 100 deposit. But essentially if you had a 600K loan, that would be 876K as your valuation on what you put down. So when you take away your upfront, your stamp duty and the tax and everything like that, when I'm rounded off, it's about 860K of equity versus what we saw before, it was 653K. And that was me being very conservative. We're talking just 10 years where...
So go back there, 653K, that's in stocks?
Stocks, yep.
And then how much in property?
Oh, so no. So the shares was 470, sorry.
470?
Yep. And then 860K was the net position with property, with conservative numbers.
So you've doubled, nearly doubled.
Yeah, nearly double.
Yeah.
And that's in 10 years. So if you imagine 2030, yes, you're paying those extra fees like we talked about, but we're talking many hundreds of thousands of dollars.
And I guess you're right there as well. If you do this right, like what we do and what we've done for our clients, and you can bet the bottom dollar that we're going to beat 6.8%, and we actually guarantee that in our first year as a guarantee here at Fresh Start. So I know if you do it the right way, you can have a better return on investment with that and actually have more of a balance as well, or higher equity position after that 10-year time frame as well in property.
Exactly right. If you're buying a really bad property, you're buying an apartment, there is a lot of bad property out there, you won't see this result. Like I went with Australian average, that 6.8% is good, but the reason it smashed the share portfolio out of the park is because of that leveraging aspect. Now, from the numbers, like I do the vals for our clients, like our average is above 20% in the first year. I don't use that in any of our strategies because that is an insane figure to throw out there. Like you're beating the share market just in a flat rate as it is without leverage. So if you're imagining leveraging on top of that, that is just insane.
So what do you use when you do your, I know we're going a little bit off average growth rates, but what do you go off when you're building out a plan?
I go off 10% in the first 2 years, which I think is still really conservative. And then I just go like Australian average from there. So as we're doing the valuations and we're seeing, we're way ahead of schedule, that's just better. It just means that we're achieving our goals earlier than expected.
Yeah. Okay. Yeah. And so when you're building out a plan, when it comes to self-managed super funds, I know it depends on ages and it's, where people are in their journey. Do you want to give her a bit of a rough idea for the listener of how you would go about, I guess, maybe a 30-year-old versus maybe someone in their 50s? And I guess maybe you can spit out some different super balances, but how you would structure their deals a little bit differently as well.
Yeah, sure. I guess the key thing for me, there's always going to be an aspect of, even with just those two scenarios, there is a big, heavy consideration on the client's risk tolerance and the attitude towards property. Because the key thing when it comes to any investing strategy is understanding the client's capability to sustain the strategy. So let's just say, in my head, I'm super aggressive property. I'm happy to spend 20, 30, 40. Like if I have the cash to spend as a holding cost on that property, I'll hold it because I know the equity growth is there. If a client doesn't understand that and a property journey or strategy doesn't align with what they would ideally like to see, and there is an education piece that's part of it, then that doesn't become sustainable. And that will throw the strategy out of whack. A lot of these strategies, you need to sort of stick with the strategy. Yes, we can adapt the strategy, but at the end of the day, we need to make sure we're aligning with the strategy so that our actions throughout it isn't going to throw it off. We talked about 10 years, that's just on paper. 10 years is a long time in someone's life, right? And so sticking with the strategy for 10 years is quite vital. So we need to make sure it's sustainable, right? So it can change depending on the client's risk tolerance and what they want to do and what they want to see in their portfolio. And again, that education piece where I will leverage my knowledge, explain why we're strategizing that way. But essentially what we're looking at, the key difference, if let's just say we're taking that out of the picture, is the time horizon. So if you're looking at, someone retiring very soon, we're looking at a very short time horizon. So we're just trying to get that growth. Maybe we'll just buy like one asset and then look to sell it down. In general with the strategy, with super strategy, I almost run it separate to your personal. It's completely different. You can't touch it. You can't even do equity releases in your super. So selling property in super is a very, very viable strategy. So with us, most people say an asset will double in 10 years in the Australian sort of average market. What we look at is we expect double in maybe around 7 years. So we expect it to happen in a shorter time horizon. So when it comes to your super strategy, it's letting an asset double, selling down that asset. 10% tax is amazing for selling down an asset. Then you're able to buy 2 assets. But where we align that with your strategy is that time horizon. So let's just say you've only got 10 years. We might not be able to buy 1 asset, let it double, and then buy 2 more assets. We might have to just, all right, we've got that equity. Now we can do what we want with the equity, whether it's going commercial or maybe just want to simplify and go into shares. If someone's got a massive time horizon, we're talking 30 years, you could buy an asset, get that equity growth. You'll have hundreds of thousands more on your balance. You could buy then 2 assets with the bigger deposits or higher valuation assets, then let them grow for another maybe 7 to 10 years. And then from there, the world's always, you can start adding commercial and then buying another residential that will do the equity, and you've got the commercial as the cash flow. And then you continue to compound that until you get as much of a balance as you possibly can to then sell these down. And again, 10% tax is amazing to do that. It's even better than your personal. Sell them down, put into shares, put into commercial, whatever your priority is and what you want to achieve. But that will, again, it's very hard to predict what will happen in 20 years. Maybe commercial isn't the route in 20 years. But the main thing that we can do for the time being is how much equity can we grow? What's in our power? Like what can we how high can we make the number go by the time we retire?
Yeah, and I do agree with the buying and selling. I think the costs of buying, it's 10% of whatever the gain is in super. So it's like after 1 year, hold for 1 year, 10% pay on tax from capital gains.
Yeah.
The getting in and out of property in super is probably more advantageous compared to your personal name.
Yes.
So I do look at that, and I've done that myself with other clients, and I'm doing that for myself as well. I think we're going to look at getting something 5 to 7 years, potentially hold that property. And I'm going to look at selling and going from there, and then reinvest that and try and get 2 purchases, maybe 3 out of that, because by that time, people listening, let's just say you got 200 grand of savings in your super, of balance. If you buy a property for, say, whatever it is, 600, 650, you're probably going to have 30 grand left over, something like that. Okay.
Yep.
With that, there you let that sit there or do whatever you want if you want to reinvest it. But if you're contributing, your 12% per annum from your employer or yourself, and you're putting 20 grand or so a year as well, by the time when you sell that property, roughly you got a fair bit of balance. You probably have 400 grand, maybe 450, maybe close to 500 grand after you sell that property. So then you can then double that, and it makes sense. Doubling it, go again, and then seeing if you can triple it if you've got time again. If not, if you can, depending on the lending and the borrowing capacity. And then when you get to that point where you've got $1 million or more in your balance from the sale of those properties, can we go commercial and buy a nice property?
Yeah.
It's just going to sit there and give us cash flow as well.
Yeah, and that cash flow you get from a commercial that's even a $2 million or a $3 million valuation, that smashes even just that pension amount I told you out of the park. You could very realistically live on that just on its own. And keep in mind, this strategy is completely separate to your personal strategy. So alongside that super just running in the background, that strategy just running in the background, at the same time, we're building a portfolio in your personal name, and that will help you achieve your short-term goals, like whether it's paying down the debt in your own home or once you've paid that down, you might go for cash flow. All we're doing in your personal name just has to go up to that retirement age, let's just say 65. And then from there, you've got access to all your super balance and what we built in super. So it's almost in a way like for your personal, you don't have to make it last forever.
But you've got that as well. Tax, when you hit the retirement age, that's tax free as well.
Yeah.
So all that income you're generating, and that's where I think people go wrong. They get to the point when they get to retirement, they buy a property and they will sell it and they'll just live off what they've sold it for. I think if you can create a passive income, that's tax free. So if you buy a commercial property and it's generating, let's just say 50 grand a year, or if not even 100 grand or even more, and that's tax free. That's a lot of money for someone to live off when you get to retirement, and especially when you don't have many. You're 65. You don't have all the other things. School fees and all the other things that come involved when you're in your 20s or 30s, bringing up a family. So you can enjoy that money a little bit more, and it goes a long way too. So I think it's a great way to structure a portfolio, and I think people probably would have got a lot of value from that.
Yeah, and it's not really like the only way to go about it. Like, yes, there's pros and cons to even commercial. Like, yes, you can tax through money. It is nice that it's like a never-ending sort of income in a way compared to like just having a bank account where you're just chipping away at it. Like, let's say instead of that income you had like 200K, it's just sitting there. yes, that might last you your lifetime, or let's just say it did. You would just be chipping away at that. That may not feel as good as for someone as opposed to getting like an income from their investments that's continuously coming through. But there is still value in, let's just say you've built up the equity. You don't have to go commercial. You could then go into investing that into share markets again, because now, like I talked about, it's very powerful when you have a massive balance. First, you've got to get that big balance, right? But once you have that massive balance, you could find that that portfolio is growing by maybe 200K a year just on its own. And then you might only be taking out 100K. So it's kind of like infinitely growing. It's like an infinitely growing bank account because you're not taking out as much as it's growing.
Yeah, definitely.
So that's also a valid strategy because let's just say you have a massive expense. Maybe it costs you 600K. I don't know what it would, but let's just say you did have that. If you did have a commercial, you couldn't necessarily sell down the commercial just to make that shortfall. Whereas with shares, you could just spend it.
Yeah.
So there's pros and cons to each. It just depends on what you prioritize and what you're comfortable
Of course,
with.
and what your goals are and
yeah.
the type of person you are.
But the first thing you need to get is that balance. So it gives you the options. That's the main thing.
Definitely. So I guess what I want to leave the viewer with is some tips, things for them to kind of try and do with their super portfolio or super in their portfolio and their super and what to do. I think number one, and just to give people a bit of a framework, is kind of review your super performance.
Mm-hmm.
I think people don't look at their super. You ask them how much they got in super, they guess. They go, "Oh, I'm not sure. I have to get back to you." They don't know what it's returning. Is it 10%? Is it 7%? I think mine was returning 5% last 12 months, and I was like, "Oh, geez, that's not doing anything." So I'm like, "All right, pull it out. Let's go." I'm going to join up with my wife. I'm going to go out there and we're going to buy property with it. Mm-hmm. So just review it and look at it. Like if you don't know how to do that, try and log into your account, or speak to your planner or your accountant. Is there any tips on that or anything that you would add to that as well when it comes to reviewing your super?
I mean, that was probably one of the biggest value adds that I got from, like, I seeked a financial advisor for myself and my wife. One of the biggest things we got out of that was just getting different options for super. Even if you're not going down the property route, just optimizing your super does make a massive difference. Even like you might even look at the fees, it's a couple of percent. It looks like nothing, but when you have a massive portfolio over the years, that does add up to hundreds of thousands of dollars in fees. Yeah. Yep. And the difference in that, if you're looking at different providers, it's money that should be in your pocket at the end of the day in your retirement. So really just optimizing your super rather than just forgetting about it, that in itself will give you a better outcome for yourself in the future. You will be thanking you for that. From there, you can obviously look at different investment options. Should you consider, obviously I gave you an example, but if you run the numbers yourself, and I just use very conservative numbers, you can see for yourself, all right, can I do better than what this, super fund is doing?
And that was going to lead me into number two, is actually looking at that as well. So number two is just review it, but I would look at your performance. If you're being for super fund for 5 years or more, look at what that average growth rate is, and then compare it and go, okay, this is what it looks like. If I'm 10 years, 15 years from retirement, or 20 years, whatever it may be, do that compounding. If it's 5% you've been achieving, what's the end goal look like?
Yeah.
And just review it, okay? Just see what it is. If you've got 300 grand today and by that time it's going to be 800 grand or 700 grand, whatever it may be, that number is that enough to survive? And if that's two of you in a household and you get to retirement age and that's not enough, okay, then once again, I think you start looking at, okay, is there other funds or other things that can get a better return on investment on that?
Yeah, exactly right. I think if you just put the extra little bit of effort to crunch the numbers yourself, like I kind of went through an example of some of the considerations, but it is really powerful to do that yourself. Then you can sort of see the difference. And that was a 10-year time frame. Maybe you only have 10 years till retirement. So that's a pretty accurate example. But yeah, that will just continue to compound and be more and more different. And so it's your family, your money, your life at the end of the day. So if you can't be bothered doing it, that's your own decision. But if you've been given this information, I highly recommend you look at it, compare it for yourself, and just make your future you glad you did.
Definitely. And then I think from there, even if you're not sure, speak to an advisor, financial advisor, a trusted advisor. Do your due diligence, understand super more. Some people actually go into a meeting, speak to these planners, they don't know what's going on, they don't know the language that they're talking. I'll just look at some YouTube videos, podcasts, just get familiar of understanding what's going on here. So understand about the fees as well that you said. There's a lot of hidden fees and things that people don't know and kickbacks that they're getting from different funds as well. And I think that's important to understand that as well.
Yeah, it's good to understand sort of every aspect involved with something like this. It is easy to forget about super. You don't put the money in yourself. It just comes out like from your employer, etc. But it is a massive, powerful tool that, when you do hit a certain age, you will start to care about super a lot.
Yeah.
And there's no point looking back, saying like I could have done a lot better with it at that point.
Yep, definitely. From there, I'll look at salary sacrificing as well. If that's something that aligns with your strategy, your risk, and where you are in your journey too. But that's something to speak with those, of course, your advisors. And if you're someone that's self-employed as well, even just look at, okay, can I start contributing?
Yeah.
A lot of people actually, put on the side. A lot of business owners are like, no, I want to use the money now, and they want to do whatever they want. If they go buy a car, go on a holiday, or go buy and invest property in their personal name. Fantastic if you use it to that, advantage. But if you don't and you're just spending on discretionary things, can you start planning for your future as well?
100%. That's a really good point. We do see a lot of business owners, because they're not having that money just automatically put in there, can be easily forgotten about. If you don't have that money in a super, or if you haven't set up for your retirement in some way, then it's the same situation. You don't want to be looking back and thinking, oh, I haven't thought about this, because whatever investment you're looking to do, you need a long time horizon, at least like a reasonably safe investment. You need a long time horizon, whether it's property, shares, you need to let that grow. So you can't be looking at this when you're 50, because you might not have enough time. You should look at it as early as you can. Like 50 is actually reasonable. If you're like 55,
yeah,
you need a lot longer. You want to look at this as early as you can and make those moves and decisions now. And then once you've done that, you can review it, but it's much easier to review over time rather than do all the research. It's just like a once-off thing. You learn as much about it, and then obviously continue to review it. But that effort you're putting now will compound.
Yeah, definitely. And that was my next one, review your options. And I think if you're at those ages that you mentioned as well, what's going to be a great investment, and do your research as well. Someone might tell you, hey, do stocks or do ETFs or do property or whatever it may be. Just challenge it and do a bit of research and understand it as well, because I think not property is not for everyone too.
Yeah.
So I think let's go back to those tips. Review your portfolio, your super portfolio. Plan out what that balance is going to be like in the future, okay? Look at your balance now. Look at the return you're getting, and then compound that over the next 5, 10 years, or whatever it is to when you retire. How much are you going to have? That should scare you, give you the awareness to do something different. Speak to an advisor or someone trusted, a trusted advisor, and have a look at your options and how you can improve that, okay? And then look at those options as well. If you want a salary sacrifice, add more income, or even start adding a super balance, super contributions if you're self-employed. That's very important. And then just review your options as well. Is it going to be, what investment is that going to be? What's the strategy? What's the plan? Okay. And then, of course, take action from there. Yeah. Okay. Good summary. Well, thank you, Mr. Anu. Is there anything that you want to leave the listener, the viewer, before we say goodbye?
Anything I'll leave them with? What do you normally leave them with? Like a joke or?
No, from today's podcast, I guess, is there any advice or anything that for someone out there starting, or if they're already started, anything that you want to just add to today's conversation?
Yeah, I think when it comes to, I know we're talking a lot about super, but when it comes to investing, or, it's easy to go by life and, just what comes next, tomorrow, next week, what's coming around the corner. When it comes to investing, like I just said earlier, you need long time horizons. So having a strategy, having a plan, doing your research, every investment vehicle has pros and cons. There's nothing that's massive cash flow, massive equity. Every single investment type, not even just in property, like everyone has a pro and con. So if you're investing your life savings or your retirement fund into something, understand it, know what the pros and cons are, and then make an informed decision, whatever it is.
Yeah.
And then, that's probably the best way in which you can set yourself up for the future, set up your family, future generations, is that little bit of effort that you're doing today.
Yeah, awesome. Love it. Well, if you got value from this, we say please subscribe if you are listening and you have been listening to our podcast for a while now, because this just means that, we get people that are listening, and if you give us your feedback as well, what you would like us to talk about too, we'll definitely get back to you guys as well. So please subscribe if you are watching and you are getting value from this podcast. And if you know of anyone that would get value from this podcast in particular about super, please share that with them also. All right. Thank you, Mr. New. Look forward to having you on again, and we'll probably do another one about property strategies and how to probably replace your income in a short period of time.
Sounds good. I love it.